Hello everybody, welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy, I'll be presenting. As we get going, let's do a quick systems check. If you would, type OK in the chat box if you're hearing me clearly and seeing my screen all right. All right, great. I've got enough responses. Thank you. Looks like we're up and running fine. If anyone has any issues as we go along, please feel free to let me know. As always, keep in mind that no one trade is guaranteed to profit. There's risk with each and every trade that you take. So you want to have a risk management plan in place that makes sense to you for your preferred risk reward that you're going after, and setting up the downside as well in terms of how much exposure you want on your trade, etc. Our web trader and our AvaTrade Go app assist quite a bit with that, by the way, and we'll go over some ways that it does with the trade calculator built into the order window, and AvaProtect, some other ways of helping to manage risk as part of your risk management plan. But in one way or another, you want to make sure you're aware of how much you're risking on each move and managing risk in a way that makes sense for you. Now, keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Real quick, for anyone who's in the webinar who's new to things, and I know we get a mix of experienced traders and non-experienced traders. So real quick, what is fundamental analysis? Basically, it's the news. It's what's going on around the world in the headlines, in the economic reports, in the numbers coming out of different countries about jobs and GDP, etc. And so you have a couple different main types of fundamental news then that comes out. One we might describe as regular economic events, like those you find on an economic calendar. And the other type of fundamental news we might refer to as extraordinary economic events, like a war or a global pandemic or Brexit or any number of things that come up. Yeah, Vanu example, it's simple, it's news and events around the world. So these sorts of bits of information and headlines and such tend to move the markets in one way or another. And if you can understand the headwinds of what's happening fundamentally, many times it can give you some insight as to what direction certain instruments might move. And so, for example, with oil prices climbing so high, why was it so predictable that that was going to occur? We knew there was high inflation with currencies very weak because of low interest rates and a lot of stimulus handed out that weakened the currency, so prices could rise on just about everything. And at the same time, the war broke out between Russia and Ukraine, and created a lot of fear about supply disruptions with crude oil and natural gas, and some other commodities as well. And so when you understood the fundamentals, then it was easy to pick the direction that you might prefer on something that was affected by those fundamentals. And so that's just one example that occurred recently. If anyone wants to give any input, by the way, as we go along, or if you have any questions, please do so in the chat box. I'm happy to address any questions or to share information if it's pertinent that you might have to give. Now, real quick, since we're talking about different types of fundamental news, let's look at some fundamental news that came in. We can go here and talk about, excuse me, just trying to get rid of some of these ads popping up. Okay, so we can go here and talk about earnings optimism. It is earnings season. You know, every quarter, every quarter, which is every 3 months, the corporations, the big companies release their earnings numbers, their earnings per share, their revenue, etc. And sometimes they do better than expected. Sometimes they do worse than expected. Well, there's optimism about numbers coming out today. And so that helped the market rise today. So earnings optimism helps Wall Street shrug off rising yields. There's another part to that headline that we need to make sure we understand. Besides earnings optimism, what are we talking about when we talk about rising yields? Well, basically, we're talking about the interest rate that banks are willing to pay for you to give them your money. And so, if you buy into bonds and they're offering a yield, certain guaranteed return over a period of time, whether it's a shorter term bond or a longer term bond, in general, the yields are rising. They're trying to get investors to buy into the bonds. And so a lot of times when the yields become inviting, meaning they get higher and investors start to look and say, well, is there any fear on the horizon for the riskier investments like stocks, for example? And if the yields become enticing enough, a high yield return on bonds can spur a sell-off potentially on the stock market. Okay, so today the opposite occurred. Yields hit like a 4-year high if you read into what the numbers were today, and but the stock market went up, not down. Okay, so you could start to look at this as a potential opportunity that if 4-year high rise in yields means if fear hits the market, those bonds start to look attractive and could spur a sell-off on the stock market. Is there anything that could create fear coming up soon, especially in the US stock market? What has the FOMC committee in the US promised to do multiple times this year, which they've already done once? In fact, they said maybe 5 or 6 times at each FOMC meeting this year, they may very well raise interest rates 0.25%, 0.5%. That's basically what they've talked about doing in order to stave off the hyperinflation that's been occurring around the world and largely in the US at record highs. And so we start to look at this headline, we say, okay, there's optimism, but these rising yields we need to pay attention to, because usually rising yields causes the opposite direction movement than what we saw here with everything in green going up. That's why it says earnings optimism helps Wall Street shrug off rising yields. Why did they have to shrug off the rising yields? Because usually those pull the market down. Today they didn't. So that could be in your favor if you're potentially looking to short the market on stocks or indices. These high yields could work in your favor at some point. No guarantee, but that's the general way that tends to go. All right, so crude oil slumps. Here's another headline to undress. Crude oil slumps. China's COVID outbreak continues to weigh. Those two are related, by the way. Okay, crude oil's been up because of hyperinflation, meaning weak currencies, and increased demand for crude oil coming out of the COVID pandemic and the war between Russia and Ukraine. Kind of a triple whammy shot crude oil prices up above 100 a barrel, well above 100 a barrel. Well, crude oil prices have pulled down today and recently. Why? Partly because there are COVID fears in China. Not necessarily that people are dying in mass numbers from COVID. I don't think that's happening in China, but the fact that it's causing China to do lockdowns, maybe hurting their economy. And so, you know, China being one of the larger economies in the world, if they're shutting things down again because of COVID, and there's fear of an economic slowdown there because of that, well, then that could reduce demand for crude oil. So speculators are selling crude oil. Not that their economy has slowed yet, but the anticipation it could. Crude oil came down. Okay, so now that could be an opportunity if you think the war between Russia and Ukraine could get worse before it gets better. Maybe that's an impetus to make crude oil go back up. So you see the seesaw battle here between different driving forces on something like crude oil. So those are headlines to keep in mind as we start to look at charts and analyze the technical analysis. You might have a preferred direction that you might want to trade on certain instruments or certain currency pairings that are related to those instruments. For example, who can type what nation's economy is very largely dependent on crude oil exports as I think pretty much the #1 portion of their GDP. And it's not what you might think. It's not the largest oil producing country, but it's a country whose GDP is maybe the largest dependent on crude oil exports. I'll give you a hint, it's in North America and it's not the US. Yeah, Canada. The Canadian economy is largely dependent on crude oil exports. And you think about the fact then, Alfred, yeah, you were the first to type it. You think about then if crude oil went down largely today, maybe we look at the Canadian dollar and see maybe it has some potential to drop as well. Because a lot of times there's a correlation there between the strength of crude oil and the strength of the Canadian dollar. Usually when crude oil does really well, that helps the Canadian dollar be stronger and vice versa. Again, there's no guarantee that they'll follow each other, but there's an economic connection there, fundamentally speaking. And since we're talking about fundamental analysis, we'll maybe take a look at the Canadian dollar versus the yen. If fear was down today and the market was up and oil's down, let's see if we can find an opportunistic entry point maybe for something like the Canadian dollar against the yen, which we would think should eventually maybe pull down if oil stays down. All right, so let's take a look first at the mobile app. I think that's a good place to start. I am logged in on my mobile app. Got it connected here to our screen. So let me do a full screen share. And if you haven't used our mobile app, I recommend that you do. It's got some great risk management tools, some fundamental analysis tools, technical analysis tools, etc. built in, just like our web trader as well. And you can trade on your MT4 and MT5 accounts right from the app. So I'm going to tap on this little tab here, and we'll take a look at, we could look at Market Buzz. It gives you fundamental news on stocks. Okay, so if I tap on that, we're talking fundamentals. So now this is strictly on stocks, and you'll see the ones that are trending the most come up first. The most articles have been found online, and trust me, this is finding very recent articles. They're time stamped by the minute coming in, by the hour, etc. So Tesla, Twitter, I mean, those are the ones you'd expect to have the most trending, with what's going on with Elon Musk wanting to buy Twitter maybe and turn it private, and he's connected to Tesla, so it makes sense. Those are the top two right now. And so, if you want to read the articles that are available on any particular stock, then you tap on the stock and it loads a page dedicated to that stock, showing some basic trending news, social direction, etc., and then also a link for each and every article that was found only 30 minutes ago. An article that includes something to do with the stock that you clicked on. That's each of these articles will be related to, in this case, Tesla. And so you can click and find your fundamental news very quickly and efficiently on whatever stock you were thinking about maybe trading on. Okay. Also in this function, in this area, by clicking on the tab, we can get technical analysis signals. And so if we go to featured ideas or analyst views, we're getting free signals coming in from Trading Central. And so we see USD's been strong today. US dollar up against the Canadian, up against the Swiss franc, up against the yen. Okay, makes sense. They're talking about raising interest rates in the US multiple times soon, potentially. And so it makes sense. The US dollar has been bullish. It's been strong. And so if fundamentally the signal makes sense, then you click on it and you check and see if the technicals make sense to you. Okay, crude oil was down today. Makes sense. The US dollar might rise against the Canadian. Okay, and so you pick the signal that makes sense to you fundamentally as well, maybe, and there's the technical analysis for you. I'm pausing just for a second to type a message. Type okay if the audio and video is all right for everybody. Someone's saying it's all froze up for them. All right, thank you. I've got enough responses. I'm just going to let Xavier know that it's only an issue for him. Okay. So we're looking at the signal here. And so if you already have your fundamental idea, hey, US dollar is strong because of interest rate increases coming potentially. And Canadian dollar maybe should be weak today fundamentally because crude oil pulled down a bunch. And so then we take a look and we say, wow, this signal made sense. So we go and we look at the technical analysis. We see there's a support level here from the past on the 30-minute candles. So it's saying as long as the movement doesn't break below this old support level, then it's a buy signal. If it breaks below that level, then the assumption would be, okay, the fundamental situation must have changed. Then the signal's no longer valid. That's the way you read these signals. So this is the fail-safe line. If it drops below that, then they say don't go with the preferred direction, in this case, a buy position. And they're saying as long as the movement hasn't reached these take profit suggestions, the green lines, then go ahead and buy with your stop loss maybe below this support level. Okay. And then if it does break below the support level, they're saying the alternate scenario is to sell. So they're acknowledging the first move could go wrong. You're not always going to be right. The fundamentals and the technicals at the time the signal came out said you should buy. And if you still think it's at a good price to do so and the fundamentals still support it, you know, maybe it hasn't broken the support, but it's somewhere close to it, and you think the fundamentals are still on the side of the Canadian being weak, etc., then you make the move. And you also could put a pending order down here below that support level so that if it does break below, it says then you should sell. It says look for further downside if it breaks below that 125.85 price, this blue line. So this is the way you read these signals. It gives you a market move and then also a backup for a pending order in case the market move goes bad. And typically, as you look through these signals, if you do a quick fundamental news review, you're going to realize real quick that, the signals make sense for what the fundamental news situation is. And if it doesn't, then don't trust the signal if you don't think it makes sense for the current fundamental news. Every once in a while, I'll see a signal and I say, that doesn't make sense to me. But usually they do. And so then you pick the signals that make sense for your fundamental news review and then look at the technicals and see if it's at a price that looks good. And likely this already rose. And if it didn't, then maybe it's a move you want to make now. It's up to you. And it's also up to where is the price currently. So all of these features, including more features that are in the app, are also in the web trader. So I want to go to a full screen view. Let's leave my phone sharing. And I'll shut down my phone. And let's go to the web trader. So where do we log into the web trader? Right up here. On our main website, you just click log in and you'll be able to log into this platform here. This is our web trader and it has the same functionality as the app, only full screen. So, and by the way, the web trader works from a mobile as well, but I think the mobile app functions better from a mobile. It's designed to be on a mobile as a number one method. And the web trader will work on a mobile, but I think better on a full screen. So I would recommend use our app on a mobile device, use the web trader on a full screen computer or tablet. The venue, good question. And the signals coming in from Trading Center are updated quite frequently. Now, if you mean if a signal came in an hour ago or 2 hours ago, do they go back and update that old signal to change it? No, but they give you the price levels to which it's still good. And so if it's beyond the take profit marks, then obviously that already carried out. If it already broke the support level, then that's no longer a buy signal in that example, etc. So they're timestamped when they came in. There's not really an expiry on how long you might still think that they're valid, other than the price levels kind of give you that indication as to whether you still might be interested in it or not. But the signals are coming in as rapidly as the market dictates. Could have 3 or 4 that come in within 5 or 10 minutes. It might be 30 or 40 minutes before the next one comes in, etc. It's kind of market driven as well, how many signals and on which currency pairings, etc. that the signals will come in on. All right, so those of you who've used our web trader in the past, but not recently, you'll notice we've added more features and more features will come. we've got multi-chart functionality now. So I've put in this view, you can go 1 chart, 2 charts, 3 charts, 4 charts. I've got 2 charts right now, and you'll see real quick why. So the crude oil, I'm on 1 hour candles for both charts, I believe. Yes. Okay. So we see crude oil drop today. Look at the 1 hour candles, down, 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 and flattened out, starting to climb a little. We see the Canadian dollar went up today, up, and found resistance. So on the Canadian dollar chart, I can clearly say I see resistance has formed here on the 1 hour candles. It hit and dropped. It tested it and dropped. It hit, dropped. It hit again, starting to pull down. Why did we say the Canadian dollar potentially from a fundamental standpoint could be a little weak today? Why might it pull down? Not guaranteeing that it will, but what are we looking at on the left-hand side of the screen that we said is a large part of the GDP of the Canadian economy? It's a facetious question, I know. Crude oil showing. We already talked about the fact that Canada exports a lot of crude oil. Crude oil dropped a ton because of the fundamental news about China having economic fears because of COVID again. So we see crude oil drop, and we see the Canadian dollar kind of cap itself with resistance after crude oil already dropped. So potentially there's a reason for the Canadian dollar to drop. Okay. And so why pair the Canadian dollar against the yen, though? The yen is a safe haven if there's any fear. What just ramped up more today in response to, or I shouldn't say in response to, but what ramped up more today? The conflict between Russia and Ukraine, right? The invasion kind of, Russia kind of redoubled their efforts after taking a pause, and they're hitting the eastern side of Ukraine really hard. Maybe some fear hits the markets because of that still. Maybe fear hits the markets because of what's happening in China with COVID. So there are some reasons out there why the yen could strengthen maybe after being weak today. The yen being a typical safe haven currency. So you pair one currency against another where you are hoping that the one will strengthen while the other is weak. So the Canadian dollar maybe has a reason to weaken with oil dipping, at least temporarily. Oil has dipped, but it's been a pretty steady drop today on crude oil. And so if the yen has any reason to strengthen, which there's some potential there for the Canadian to strengthen, or I mean for the yen to strengthen, then maybe that's a good pairing if you think the Canadian could weaken and the yen could strengthen. Strong horse, weak horse. Okay, strong horse, weak horse is what we're talking about. So that's why I chose that pairing. With fear maybe being able to hit the market still with hyperinflation, increased interest rates coming in the US maybe, the war ramping up further. There's a lot of reasons for potential fear, which could make the yen strengthen, and oil dipped so the Canadian could weaken. This is all speculation, right? But it's all fundamental analysis. This is how you do fundamental analysis many times. You speculate about things that have happened fundamentally and a movement that hasn't occurred yet, like the Canadian potentially dropping after crude oil dropped. Okay? Many times you'll see these follow each other. Whichever one leads, the other one follows. Not all the time, but sometimes. Okay? There is a correlation between strength of Canadian and the crude oil movement. So let's see if we can go after this setup. So if we're potentially selling, take profit could be down here. Let me draw another line. Take profit could be just before the first support level, maybe down here. Okay, we see resistance, we see some support down here that went up. So maybe we go after down here. And the stop loss would be just above the resistance, so up here somewhere. Right, 102.15 or 102.20, something like that. So take profit 100.68. We could even do something a little higher than that. 100.7. Okay, as a stop loss right in this area. And maybe I cheat that up a little more, 7.5. And then we do, that's take profit. If I said stop loss, I meant take profit. Stop loss would be up here, let's say 102.15, something like that. If it breaks the resistance, then maybe you get out. Okay, so look at that ratio. Possible profit 79, possible loss 1150. It's changing by the second because it's moving. But you see, it's like 8 to 1, 7 to 1, 8 to 1 ratio potential profit to loss. Why? Because it's such an opportunistic entry point if you think it's going to drop, right? So I could even cheat my stop loss up a little further. Maybe I go to 102.20 to make sure I'm all the way past that resistance level here at 102.15. Okay. And then my take profit, maybe I say, you know what, I can get out a little sooner even, still have a nice profit. What if I go not 105, 100.25. Okay. Still a nice ratio, right? And so you play around with where you want the exact take profit, somewhere before the support level, right? Might make sense. So 102.75, still a nice ratio. So I'm getting a little higher, and I could even go 101, and it would be more potential profit than risk. Okay, so I'm at 102.7 or at 100.75 at the take profit. That's right up here, above the support level that I drew here. Okay. All right. So now what we can do is say, well, how much am I willing to risk on this trade? And this is where the risk management comes in. Okay, you should know how much do you want to risk on a particular move. Let's say I know I want to risk a certain amount. Let's say, I don't know, 500 on the move. Okay, so if I know I want to risk 500 or whatever it is you want to risk, now I adjust the trade size. There's half a lot. I'm risking 160, it says, to my stop loss. So let me go 2 lots. Now I'm risking 540. I said 500, so I need to go a little less. 1.75 lots. Okay, 420. I can go a little bigger. 1.9. 1.8. Okay, there, 486. That's close to 500. And it's moving, so it's changing. It's right above 500, right below 500. So I say, okay, that's the amount I want to risk to my stop loss. It's calculated for me. Here's my possible profit over 3,000, 3,100 and change. If I like the setup, then I'm ready to sell. Oop, I got to get my stop loss reset. $102. It has to be a certain minimum distance. Let me go 102.8. Has to be a certain minimum distance from the market price. It was telling me the minimum it needed to be. Okay, so still a great ratio, and now I sell. 3,200 potential profit, 450 potential loss. And there we go. So it makes it foolproof. You see the notices pop up. If your stop loss is too close to the market price, like mine was there, it gives me the information right below. I knew I needed to adjust it, and there it goes. So very simple risk management. You get everything set up. And by the way, on the MetaTrader platforms, which you're trading on those accounts from here, you don't have all this extra information and help with calculating your risk and all of that in the order window. It doesn't give you that type of communication. So it's a benefit of using the web trader and our app. Okay, so any questions so far? Questions, comments on the simulation I did? By the way, this is a dummy account. I'm not on a real live account. I know it says real, but it's a dummy account that I need to use in the webinars. But you certainly can be trading on live accounts, demo accounts, whatever you wish. Tapiwa, you're asking what's my recommended risk to reward ratio, and I say I don't recommend a certain risk to reward ratio. That's up to you. You have to be okay with the risk reward. There's no one right way. I will say that there's no one right way to do it. The way I set this last trade up, I could be wrong 5 times, 6 times, and right once, and then I would still be an overall profit. But that's not the only way to set it up. You can also set it up where it's equal risk and reward. You can set it up where your stop loss is further away than your take profit, which typically then increases your win percentage, but not necessarily your overall P&L. It depends on your strategy, and there's a lot of different strategies to use. I think I let the fundamental news and the chart determine what the distance is to my stop loss and my take profit. Okay, you have to go with where the price is and what do you prefer to trade on, and it's not always the same. It's not as ideal maybe as what we did there, but that you're looking for that type of setup many times though, where you can risk less and have a larger potential profit. I do tend to look for lower risk and higher reward, but only if it's an opportunistic setup in the direction that the fundamental news says maybe the movement should go. In the case of the Canadian JPY, I feel like maybe that's the case. It's right at the resistance, and there's reason why maybe it won't break the resistance, reason why it might pull down. And so I view that as a potential opportunistic entry point to have to risk less to get beyond that resistance and have a larger potential profit even before it has to break the support level. And so it feels like an opportunistic entry point, but that's only if you feel that it should drop, right? So that's the part that's subjective. It's up to you as to how are you interpreting the fundamental news. Okay, so let's look at maybe something different. We could look at something like the S&P 500, for example, otherwise known as the US 500 on our platform. I'm going to go to a single chart view for this. Or sell, buy or sell, doesn't matter which one I click, I just want the chart. And let me expand it. So now we're looking at the US 500. And what we can do is maybe go to a larger view. Let's go to 4-hour candles. Okay, so what we see here is the market has had some trouble. We see a downtrend, right? Coming down here. See the low points getting lower, the high points getting lower, right? In an alleyway. Down, 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 down. Down like this, okay? That corresponds to the large rise in oil prices, corresponds to the timing of the war between Russia and Ukraine. There was a lot of fear that hit the markets. And so we see on the 4-hour candles, this large drop, this pullback in the market, and now a bounce back up on the 4-hour candles. Hans, the overnight swap, otherwise known as interest rates, are found on our website. So go to the trading instruments section, click on any individual name listed in the trading instruments, and you'll see the buy interest rate, the sell interest rate for overnight interest. It's different for each instrument, okay? Typically, it's very small cost in terms of the overall P&L potential of the move. So I wouldn't say don't hold a trade overnight because it could collect interest. It depends on your strategy and the size of the trade and how long you plan to hold it, etc. But the interest rate is pretty minimal if you look at it from a nightly perspective. Okay, so what we're looking at here then is a larger downtrend, but a bounce back up that has reached a resistance level. And if I drag this up, you can see here, this was an old support level here. Let me get rid of maybe this line. We see that there's an old support level right here. Support, 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 support. And if you don't know what a support level is, it's an area where the price had trouble dropping below, and it keeps bouncing back up from that price. So you see it held here and bounced. It held here and bounced. It held here and bounced. Again here, and then finally it broke below that price and found resistance on the old support, which is typical support and resistance theory, that when a support level breaks, whatever fundamental news caused it to break, if that fundamental news still exists, i.e. the war or the knowledge that interest rates might go up soon, whatever fundamental reason caused this support level to break, which maybe is both of those things I just mentioned, those situations still exist. So now what caused it to break that support causes it to stay below. So the old support becomes resistance. Resistance, right at the same price level that it used to be support. So now we see today the market rushed up, but it stopped rising right at the resistance level. Okay? That's the value of looking at the larger candles. Now let's zoom in to maybe 15-minute candles and see what's happening. Here's the rise, and here's the resistance. It's having trouble breaking above there. Now the question is, do you feel like the market could pull back down? Is the reason, fundamentally speaking, that the market could pull back down now after that large rise? And there are multiple fundamental reasons why you might think yes. Like there's a war going on that could drive commodity prices up still, which then creates fear in the markets because of increased energy costs. There's also the knowledge that, hey, the U.S. eventually here plans to raise interest rates multiple times still this year. That the market tends not to like, higher interest rates. And so unless you're buying into bank stocks, specifically, banks tend to maybe do better with the higher interest rates. But the indices in general, like the S&P 500, the NASDAQ, Dow Jones, or other major indices around the world, they tend not to like higher interest rates because it makes the cost of doing business maybe more expensive. Okay, so if that's your view, if you think fundamentally this is an opportunistic spot to sell from, then it's a no-brainer, then you sell. And I'm not saying you have to think that, but if you think that, then you start to look and you say, okay, I could put a take profit maybe at the first support level here, which was an old resistance level. Resistance, resistance, resistance. Then today it breaks through. So potentially it could pull back to that support level. If you're looking bigger picture, you could look at a lower support level, down maybe here, which is where it was this morning. Okay, it was down here just today as well. So depends. Do you want to get out quick? Do you want to get out maybe being more patient? I'll go with the more patient approach. Keep in mind, this is only 15-minute candles. It was only several hours ago that the price was down here. Okay, so it's not so far down. So let's pretend we want to take profit at this support level, and our stop loss will be above today's high point. Okay, so take profit on a sell down at, for example, 43.78. Let's say 43.80. We'll just round it off. 43.80, and stop loss above 44.50. Let's say 44.55 to get above today's high. Okay, so potential profit 60, potential loss about 15. So we're talking 4 times ratio. Again, you don't always have to set up that way. Like I said, I tend to look for that. I think most traders tend to look for that. It's nice to risk less and have larger potential profit if the price levels look opportunistic for you. It's not the only way to trade, but it can be a good way to trade sometimes. Now, so take profit, stop loss, set. Now I say, okay, how much did I say I'm willing to risk per trade? Whatever that is for you, then you can do the risk management right here. So if I said 500, then okay, I'll stick with 500. So I start adjusting the trade size until I see the amount I'm willing to risk show up. Okay, a third of a lot gets me at about 500 possible loss to my stop loss. Potential profit, almost 2,000. Okay, great. I've got it all set up and I sell. Okay. By the way, you could buy if you feel like, hey, this move shows upward momentum. This is a pullback. Now I want to buy. By all means, you can buy. I just feel like the fundamental news is kind of telling us the opposite with the rising yields on bonds that tend to cause the market to drop eventually, many times anyways. And, increased interest rates coming, which could strengthen the U.S. dollar, which also could pull stocks down some as the U.S. dollar looks like maybe a better investment. If folks know interest rates will go up on the U.S. dollar, that tends to strengthen currency. So that might look like an opportunistic investment as well to sell stocks and buy the USD, etc. So I'm just looking for fundamental reasons why I would trade the direction I trade. And so if I feel the fundamental news says, hey, this could pull back down, then that's the direction I might trade. And if the technical entry points look opportunistic, like this setup does for potential profit being larger than risk, if you feel it'll drop, then it becomes a no-brainer to make that move. Okay, we've been going for a good 40 minutes. I think we've got the idea about today's movements. Any questions? Any input anyone wants to give before we end things? By the way, if you take a look at the cryptocurrency charts, they had quite a bounce today. For those of you that live in an area where you can trade on cryptocurrencies with us, you may take a look at some crypto charts. As the markets rose on the stocks and indices, so too did the cryptocurrencies. So you could look for potential reversals, or after a pullback, a potential bounce back up. There was a lot of movement today on the cryptocurrencies as well. Tapiwa, I'm glad you enjoyed it. Welcome if it was your first webinar. I do these twice a week, typically. So it's every Tuesday and Thursday, usually Tuesday at this time, Thursdays at 11 a.m. UK time, so earlier in the day. On occasion, because of vacations or holidays, etc., it'll be on different days, or there might be a lag where there's a week where there's a webinar that doesn't occur. But the links that you use to join, if you click the drop-down menu, it lists the dates and times of the upcoming webinars. So for example, next week it'll be Monday and Tuesday because I'm heading on a vacation for 10 days. And then when I come back, I think the two webinars are cramped into days that it's not usually on. But then after that, it'll pick back up on the normal schedule. So you can kind of check the upcoming dates through the registration links. On the registration page, there's a drop down that shows you the upcoming days and times. And by the way, all of these are recorded. So if you don't catch the live sessions, you can go to our YouTube channel and see all the recordings as well. Nadia, that's a good question. You're asking, why is wheat down? Wheat initially went flying up because of the Russia-Ukraine war largely, and also because of weak US dollar. Inflation was causing a lot of commodities and products to rise in price, but specifically wheat and other grains coming out of Ukraine were held up. The train cars couldn't get out. They're a large supplier of global grains, including wheat, and so that drove prices way up. And so it was just a pullback. It came back down. So knowing that war is still raging, potentially, if you think the war could drive wheat prices back up again, it could be an opportunistic pullback if wheat is pulled down. But that's up to you. You have to interpret the price level, whether you think it'll bounce, etc. But there is some fundamental reason why wheat prices could bounce back up if they've pulled down, like you're saying. Good question. All right, everybody, you're welcome. Good night. And hopefully you can make it to tomorrow's session. It'll be earlier in the day tomorrow. One of those weeks where it's not on my typical Thursday. All right, bye for now.